Luke Gromen, FFTT. Hope everybody had a great long weekend. Just going to kick off another episode here of two things that caught my attention recently. This episode brought to you by FFTT Tree Rings. Yes, we're sponsoring our own program here, but wanted to just give a quick testimonial about tree rings before we jump into the two things. Quote, I used to work in capital markets for over 20 years, had a ringside seat to global macro and capital flows. Now managing my own money, whilst I subscribe to a handful of key research reports, none provide the info I now have from tree rings, which gives me the feeling again of being close to privileged professional market information. Luke's depth of knowledge is second to none. That's from Nick H., who's a tree ring subscriber. So thanks for being here, Nick. Really appreciate it. And with that, we are going to jump right into the two things that grabbed my attention recently. The first thing was something I retweeted from Larry McDonald. He said that trade deal. Too many journalists are spending time tracking soybean shipments and overlooking the elephant in the room, a large positive global economic multiplier here. And to me, I replied 100%. I think it's exactly right. And to me, if you see a weaker dollar, stronger yuan, it would be very bullish for the global economy. And he was highlighting in his tweet that the Chinese yuan had strengthened again in where it was fixed to the strongest since July of last year. And it ties into my point that I tweeted earlier this week is look, if phase one of this deal contains some sort of FX component, then phase two, may not be needed for a very long time. And the point we're making here is when you read through the phase one trade deal, particularly section 5, it ties into currency and FX. And it reads a lot like surplus caps. And by surplus caps, I could go into a lot more detail, but the gist of it is that if China runs too big a surplus, basically they can only run so big a surplus. And then, the language is very focused on allowing trade imbalances to adjust and deferring to the IMF, both parties deferring to the IMF. And so it's interesting. What does the IMF think about the dollar right now? Well, last July, they publicly pronounced they thought the dollar was 6 to 12% overvalued based on fundamentals. So, we'll see. Of course, it's all about adherence to this deal. But to me, there is a lot of language in there that reads like trying to effectively implement surplus caps, if you will, on the Chinese trade surpluses vis-a-vis the United States, which would be bullish yuan, bearish dollar, all else equal if they are managed properly. Second thing, tweeted earlier this week, I'm seeing many tweets and articles about how much U.S. bank commercial and industrial, or CNY, loan growth is slowing. It's slowest in a number of years. I'm seeing virtually no tweets and articles that U.S. bank loan growth to the U.S. government is at 10-plus year highs, and it's currently running about 15% year over year, as measured by U.S. commercial bank holdings of treasuries and agencies per Fed data. So it's another sign here. It's a crystal clear sign that CNI loan growth is effectively being crowded out by federal deficits. And I think it's the elephant in the room is that the foreign private sector does not have either the wherewithal at the central bank level, the geopolitical desire at the central bank level, or the ability at the foreign private level, foreign private sector, given where FX hedging costs are. And the United States domestic private sector balance sheet does not have the marginal financing capacity to finance as much as the U.S. government needs to finance. And so the Fed's been pulled back in. And that is really the elephant in the room and of what we've really been seeing through much of last year. And then certainly that came to a head with the repo rate spike. So I think that's a really important thing. And so I think, we're going to jump here into questions. So the first question is from OD. Keep hearing parallels between now and 2007 with bundled MBS, then highly liquid, even though failing underlying mortgages, to today's highly liquid passive indexed funds, so HYG and the JNK high yield ETFs, for example, with many underlying holdings highly illiquid. And if true, how would the BNP Paribas moment look this cycle? And so for those who aren't aware, the BNP Paribas was one of the associated with the summer of 2007 when you had a couple of different subprime mortgage funds that were pretty substantial in size, several $1 billion, basically go to zero overnight. And it was sort of a holy cow moment, a Sputnik moment for much of Wall Street because these were supposedly safe instruments. And so they were investing in safe underlying instruments. And so the question here is you have this sort of liquidity mismatch again as it relates to these ETFs. And Josh Wolf, I know, is at least one person who's done a lot of really good work on that. And I would tend to agree with his view that there is this mismatch based on the work I've read from him. And so what would the Sputnik moment look like in this cycle? And it's one of these things you're not going to know till you see it on some level, but I would point you to a section of the book, Road to Ruin by Jim Rickards. He wrote it, published it almost 4 years ago now, and there's a section early in the book in which he is having a conversation with a high-level anonymous BlackRock executive. And this BlackRock executive tells Rickards, this is a conversation that took place in the summer of 2014, that the government back then, so 6 years ago, was already asking BlackRock that the government in the next crisis would call BlackRock, say you're not allowed to sell. And BlackRock, then 5 trillion money manager, I think they're probably closer to 7 now, would basically not be allowed to sell anything. And that would be the end of a sell-off, because if BlackRock can't sell, everyone's locked into place. And so what Rickards referred to in the book was called ICE 9 from, I believe it is Fahrenheit 451, but I think it's Catch-22, the Catch-22. At any rate, the point is that once one part of the market freezes, everything else begins to freeze that touches it. That's the ICE 9. And so the punchline as it relates to the question is markets, I think, will go from, I don't think these assets will become more liquid. I think the rest of the market will become more illiquid as needed to establish whatever marks are needed to be made. So from a practical standpoint, I think it's important to realize that markets are probably not as liquid as they appear, and if you do get into a crisis, they are likely to get, very illiquid very fast or outright frozen. And so it's something to consider in terms of positioning. Let's see, next question. From MH, your favorite emerging markets to play a weakening dollar in 2020. Russia's been on a tear for the past 12 months. Who could have a similar run this year? I still think Russia probably looks best among, on the metrics that we're really focused on, right, which sovereign balance sheet. You look at the current account surplus, you look at reserves as a percent of GDP, you look at gold reserves as a percent of GDP. In the case of Russia, you have the oil call option. Clearly, Putin has established himself as a power broker in Eurasia and in the Middle East. And so to me, that would probably be the one that was most attractive to me is Russia. Next question from PM. Your comments on this article, 944 trillion reasons why the Fed is quietly bailing out hedge funds, please. To summarize a lengthy article on Zero Hedge in a moment, it's basically a lot of leverage in the system that's being used by a number of different hedge funds, and that ultimately borrowing some of that leverage in the repo market, and the Fed has to bail out the hedge funds. And I think directionally, as it relates to the leverage being involved in the leverage system-wide, I think the article's very directionally correct. I think it's critically important to take a step back to see the forest for the trees and understand why these interest rate derivatives were allowed to expand willy-nilly in the manner that they were back in, and in particular why Robert Rubin, Larry Summers, and Alan Greenspan flat out prevented a proposal from Brooksley Born back in either 99 or 2000 from actually regulating over-the-counter derivatives in interest rate markets, etc., saying that if she tried to regulate them, she would cause the biggest financial crisis in 80 years. Those were Summers' words. And so the question is, why were these allowed? Why did regulators look the other way? Why did they work against regulating these things? And the answer, both from my intuition, and I've actually sort of had some conversations that support this assertion, is that they were effectively used to kneecap bond vigilantes. And so if you look back to the mid-90s, James Carville, when I die, if I'm reincarnated, I want to come back as a bond market because I can scare the hell out of everybody. Back in 92, 93, 94, there were bond vigilantes. Deficits got too high, rates rose, and it sort of reigned in the government. Well, these in derivatives allow you to just basically two ways kneecap the bond vigilantes. Number one, why sell your bonds when you can just buy an interest rate derivative that protects you from rising rates or inflation? And number two, the collateral for these instruments are treasuries. It's beautiful. It protects you two ways. So it's brilliant. Now, the issue is that there's language in Basel III regulations that are forcing an unwind to a certain degree of certain types of this leverage system-wide. And so that's creating, sort of a backdrop to this deleveraging we've been seeing over the last several years since they've been sort of rolling Basel out. At any rate, the point of the article, you say, hey, you're only going to want to own treasuries, yen, cash in case of a blow-up. Yes and no. I think yes, but if a blow-up lasts more than a couple days, the U.S. economy is critically dependent on rising asset prices. And so you'd be talking about treasury supplies on a gross basis, and not even gross, a net basis, because you'd have emerging markets selling treasuries to support their currencies. You would have net supplies of treasuries of 250 to 300 billion, 350 billion per month. There's not enough private sector balance sheet to buy that without help from the Fed. And so you'd immediately be having supersized QE. And so I think gold stands to benefit from any sort of problem here as well. And look, after September, we now know with a high degree of certainty that the Fed's not going to let the government twist in the wind for lack of funding. They are going to step in very, very quickly. And that ties into our next question from Daniel. Strong deflation, is it a possibility in coming years? Look, I think it's always a possibility, but in my opinion, it's unlikely unless things are handled really, really poorly. In my opinion, many analysts are fighting the last war on this front. And remember, we had a stock bubble. It blew up. We kicked it upstairs to the banking system, the housing market. That blew up. We kicked it upstairs to the sovereign. Now we have a sovereign debt bubble globally. And sovereign debt bubbles, sovereigns can't go broke. They can print the money. And so the release valve has to be the currency. And so, if the release valve is not allowed to be the currency, then yeah, I think we can get some deflation. But if you get any kind of sustained deflation, per my prior point, you're going to end up with nominal defaults on sovereign debt, up to and including U.S. Treasuries and other obligations, Social Security, Medicare, Medicaid, Department of Defense. The Marines aren't going to like it very much if the government says, hey, sorry, we don't have the money this month. You're going to have to hold off. Just throw rocks at them. That's not how it works. So basically, a bet on sustained deflation is a bet that a government that can print money won't print money. And that's not a good bet historically. It's a very bad bet historically. So that's where we stand there. Let's see. From CS, from the Fed's perspective, what is really wrong with continuing to pump liquidity into repo markets and effectively fund the U.S. government if it still isn't leading to inflation in their mind, while higher stock prices helps fund the government as well? And in my opinion, nothing. I think they would love to back away from being involved in markets as intensely as they currently are in an election year. But I think their hands are tied because so much of the U.S.'s debt is being rolled in short terms, right? They issued $11.5 trillion on a gross basis last year, did U.S. Treasury. 70% of that was 6 months or less. And so because so much of this roll is taking place short term, the Fed really just doesn't have the luxury with sort of the setup that we're in now to sort of stand aside in an election year and do nothing. And quite frankly, if they do and things really hit the fan as a result, I think they end up looking like the villain. And if they don't end up looking like the villain, Donald Trump's Twitter feed will make sure to point everybody that they're the villain. And as a kicker, if the Fed does that, trying to stick it to Trump, they may end up with Sanders or Warren. And to the Fed's constituency, I'm not sure that Trump's a worse bet than Warren or Sanders, at least in their eyes. And that's not my statement. That's just what I hear. Last question. Share the one chart that scares you. So at this point, with the financial stuff, I've gotten pretty philosophical about it. I'm pretty detached about it. And so the chart that really scares me, the one that I thought of, is actually not financial. So I'm going to hold it up here to the screen and hold it still, right? So this is St. Matthew Island reindeer population from 1944 to 1968, okay? And so the story behind this is that during World War II, the Japanese or the Americans were concerned, hey, there's a chance the Japanese could invade the Alaskan islands, so we're going to put a garrison of men on St. Matthew Island. Well, we don't have to work to restock them, so let's put some reindeer on the island. And being 1944, being plenty of country boys who know how to use a rifle, we'll just let them hunt it. So they put 39 reindeer on the island in 1944 for these guys to feed themselves, basically. And you can see what happened to the population. Now, Estimated K is the estimated carrying capacity of the island at about 1,600 reindeer. So World War II ends, the country boys all go home, and the population takes off and quickly goes above carrying capacity, reaches as much as 6,000 deer, and then they eat through the lichens that supply them with their food. And in a very short period of time, they go from 6,000 reindeer to 42 reindeer. That's the chart that scares me. And the reason I say that is the global economy is above carrying capacity on a debt basis. And so there are two ways this works out, the orderly way or the disorderly way. The orderly way is we, one way or another, set up deals that weaken the currency, and the dollar being the global reserve currency, the one that so much of this debt is denominated in, it has to be the one that weakens. If this is done in an orderly basis, you could have a huge economic boom. If this is not done in time, or it's done in a chaotic or disorderly basis, you're going to end up in risk markets with a chart that looks a lot like the population of reindeer on St. Matthew's Island. So that's the one chart that scares me. That's what we're going to finish up with. I hope everybody has a great week. And in the meantime, if you like these presentations and sort of the data and the way we present it, I think you'd love tree rings. Check it out, FFTT-LLC.com under the tab tree rings. And otherwise, look forward to chatting with everybody soon. Take care, everyone.